It's almost 1 p.m. in Sydney and 11 a.m. in Hong Kong. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. Treasury yields hold losses and the yen gains as data showing a US labour market slowdown, backing the case for supersize Fed rate cuts. Chipmakers helping drive a rebound in Asia's stocks benchmark. And also ahead, Chinese equities facing darker prospects after a weak earnings season as JP Morgan dumps its buy recommendation on worries about a renewed US tariff war.
And I'm Stephen Engel in Beijing, where President Xi Jinping has laid out his vision for ties with Africa, promising about $50 billion in financial support, as well as increased military assistance and market access.
Well, we're seeing a modest recovery in the Asia-Pacific after yesterday's sell-off. Avril Hong's in Singapore with a closer look. Avril.
Yeah, it was a really steep decline we saw just a day ago. Markets are rebounding, recouping some parts of yesterday's losses. I think it was 3-4%, a lot of declines on some of these major benchmarks, but the gains that we're seeing not quite recouping things all the way. Of course, this was driven by the AI narrative kind of taking a pause as traders were finding trouble justifying how far it's come. Indeed, on some of these chip names that are leading the rebounds today, we are seeing the likes of Taiwan getting an added boost thanks to the CEO of a TSMC supplier pretty much dismissing these AI worries and the NVIDIA meltdown. Now, we also got data out of the US overnight, and indeed this kind of cemented those aggressive Fed rate cut bets, and the yield on the 10-year overnight dropped about 8 basis points. Treasuries are steadying now, but it is the backdrop of a softer dollar. Offshore yuan is gaining ground, and we also saw this added boost for the Chinese currency after the PBOC's fix came in at the strongest level since April. We're seeing Chinese stocks looking pretty flat. Flip the board and let's take a closer look at the data that we got out of the US overnight. In terms of job openings, it dropped to the lowest level since 2021. We also saw layoffs rising, and all this seems to be raising those concerns that we will see a bad picture on those non-farm payrolls that are due on Friday. Flip the board again. As I say, we saw the moves in treasuries overnight, and briefly we saw the disinversion of the key part of the US yield curve. Now, for more on what the rest of the month might hold, let's get to Eddie Loh, CIO of Maybank Group Wealth Management. Also with us is Bloomberg MLive Executive Editor Mark Cudmore. So Mark, I know you have strong views of how we should be ignoring this disinversion in the yield curve, but what's your sense of the start that we've seen in September? How does this differ with August?
It's been a horrible start. I have strong views on everything, as you know. First of all, I am structurally still quite bullish US stocks. And the reason I'm quite bullish is because I think the US economy is nowhere close to recession. That's going to come into the yield curve part at the moment. So obviously, this has been a volatile start. Now, even though I'm quite structurally bullish stocks and I think there's more upside there, there's two qualifiers. I don't think it's going to be this, we've had incredible straight line gains, low volatility gains. I think we get more volatility from here on. As long as these dips we've seen this week are temporary, they don't really kind of affect my view, but if it's a real turnaround, that's problematic. As for the yield curve disinversion, I said this in the context that I have relied on this for my whole career. I feel it's been like one of the things, the most dependable signals. I've written so much about it. I traded off it. I spent time studying all the little nuances about which parts of the curve you care about. But it's actually our colleague Simon White who wrote this outstanding piece this week, really explaining why the yield curve is broken as an economic signal. And we've kind of intuitively known that over the last couple of years because it's not kind of worked with the past, but he's the first person to really explain it to me, the transition both on the supply and demand side of how treasuries are being used in the system that makes the yield curve just so kind of debunked as a signal. Now, this doesn't mean that a disinversion doesn't lead to a recession. It just means that it's unrelated, it's unconnected, so you should ignore it. It doesn't mean a recession can't happen. I think all the other factors out there, consumer is still spending, jobs market, yes, it's slowing, but from very strong levels, companies still making good profits. You've got a central bank that's dying to ease. I think the economy will hold up just fine. Atlantic GDP now Fed shows that.
is also a backdrop of how we're seeing some of these economic indicators, such as the SARM's rule, being distorted because of the past few years. But wanted to bring you in as well, Eddie. When you look at that backdrop, what Mark has said, you are de-risking. What sort of transition are you expecting here?
Right. I mean, we are with Mark here in the sense that we think that the U.S. soft landing scenario is intact. Obviously, we had the August growth scare. Likelihood we're going to see a September growth scare as well. But we do acknowledge that the next 2 to 3 months could be a tricky period for markets, what we call a tricky transition period, because I think we are actually transiting from a rate hike to a rate cut cycle. And if you look at current rate expectations, market is pricing 100 basis point rate cut this year. Fed dot plot is saying 1. We are saying somewhere in between. But this adjustment period, a process, could actually lead to some market volatility. And obviously, second point, US is transitioning into a new leadership. November elections, we're going to see more drama ahead in the run-up. And I think that is going to be another source of volatility as well.
Eddie, there seems to be a consensus that we're going to see easing in September from the Fed. I mean, we may not, let's see. But there's also a sense that we could possibly see a 50 basis point cut. Now, if that happened, how do you think the market would react? With enthusiasm, or would they take that as a sign of panic?
Well, we are currently penciling in 25 basis point rate cut because we think that while the economy is slowing, it's really not collapsing. So if the Fed were to really cut 50 basis point, the markets could perceive it as a negative, because that means that the Fed is seeing something in the economy that the market is, well, in some ways the market is pricing in that 100 basis point rate cut, but it reflects a certain bearishness of the Fed, which I think the market may perceive as a negative.
Eddie, I just want to get our viewers across some lines that we're getting from the Reserve Bank Governor, the Reserve Bank of Australia Governor Michelle Bullock. These are in prepared remarks that she's about to give in a speech. She says that the highest priority for the RBA still remains bringing inflation down, and key inflation drivers in Australia are housing costs, market services as well, and restrictive policy is going to be needed until the bank is confident about its CPI path. So not a lot of change there in the rhetoric from Michelle Bullock. That is not Michelle Bullock, of course, that you're seeing there. She will begin speaking shortly. So, yeah, the rhetoric unchanged, Eddie, but still we have very sluggish growth in Australia. Do you feel as if a cut is needed, even though inflation's not back within the target range yet?
Right, I think if you look at RBA, they are probably the most hawkish compared to the rest of their major central bank peers, right? And obviously they are concerned about the inflation. But if you look at the last GDP growth print, pretty sluggish numbers. So we do suspect that the RBA may likely ease, probably either towards the end of the year or beginning of next year. And the rate hike is probably out of the question.
Eddie, you said you de-risked, but you said you still believe in the soft landing in the US. So it's more about the volatility ahead, the risks out there from like the change in the Fed cycle, the election coming up. Does this kind of point to the idea that maybe there's a chance for the rest of the world to play a bit of catch-up, that we might go through a period of US stocks go through a volatile period, not necessarily going to a bear market, but just a volatile whiplash of going nowhere. They've had extraordinary gains already. And the rest of the world can do really well, because the rest of the world should love a soft landing and a Fed dovish cycle. That should be easing of the dollar, which would be an easing of financial conditions, and the rest of the world's still cheap. So is that the case that the rest of the world can catch up? And if so, where are the best places to do it?
Well, it really depends. If the US economy or the markets were to tank, I think the rest of the world likely will not do too well either. But if it's just a slowing of US economy and what I call this fading of US exceptionalism, this could bode well for other economies, including those in Asia. In fact, I think, for example, if you look at the Fed easing, that is in some ways supportive of Asian currencies. Already we are seeing some weakening of the dollar, right? Although maybe a bit oversold in the short term, but in the medium term we do expect Asian currencies to do well against the greenback. Asian assets would likely do well as well, and we continue to see actually, in particular, long-term growth opportunities within Asia, like Southeast Asian economies. Malaysia is actually one of our favorite markets because I think the economy is actually benefiting from this investment upcycle. It's actually one of the best performing markets in Asia, best performing in ASEAN, in fact, right? Valuation is actually still a notch below historical average, so I think that's a market to look out for, in our opinion.
What about China and Japan, Eddie?
China is a bit tricky. If you look at the recent macro data, PMI, retail sales, property sector, that is still, the recovery is still very elusive. And corporate earnings in the second quarter are unremarkable. But having said that, if you look at the valuations, I think we all know that it's not expensive. And we do believe that policymakers are ready, on standby to backstop the economy if necessary. At this juncture, they have expressed a reluctance to really launch big stimulus. But I think if necessary, they will backstop. So at this juncture, short term, we think it's going to be rangy. We are preferring to take defensive positions, like, for example, in some of the yield plays within China's space, defensive telcos, which still provide pretty reasonable dividend yields at this juncture.
Mark, I want to get your view on growth in China. I mean, compared to the Western world, it's still pretty healthy, but we've had a lot of major banks now downgrading their forecasts. I don't think anybody expects China to hit its target of 5% this year, but can it hit 5%? And even if it reports that it has, would you believe the numbers?
Paul, I feel like you're holding a grudge from last week when I pushed back on the Magnificent Seven, because you're picking on my weak point. I keep on getting China wrong. Look, I am the person who has retained a more optimistic than consensus view on China over the last couple of years, which has clearly been tremendously wrong. I've never had a super bullish view. It's just that I have felt for a long period that the negativity has been fully priced, and they've kind of proven that, in fact, it can get more negative and more depressing. It is still the situation where there is not a positive story in China. It is not likely to turn around rapidly soon. No one should be looking for China to return to the kind of narrative of old. It's never, ever going to happen. It is in a stage of long-term decline. And so we're quibbling about exactly whether they get to 5% or not. And as you say, it's debatable exactly what those numbers mean and how they're kind of measured and whether they're kind of fair growth equivalent to the rest of the world. I think the point is, from a market's point of view, there will come a time when that new economic narrative is priced. And as someone who's incorrectly thought that it had been priced earlier this year and end of last year, I will admit that I risk being stuck stubbornly in that same camp, that I think we're close to peak negativity on China, and we should stop looking for the narrative to turn more positive. What we should look for, realizing that markets are pricing in that negativity, and therefore they're fairly priced and potentially cheap and have upside because they are discounted to any positive news, not because the narrative is suddenly going to turn to a bull market on China overall.
What do you think is going to take for animal spirits to return?
Well, it took a long time to them. Well, it was a damaging period for the last 2 to 3 years in terms of consumer confidence, in terms of corporate confidence. So I think it's going to take some time for that confidence to be rebuilt. One thing, I think the property sector needs to be stabilized, and the government can probably do more on that front. Earlier this year, they talked about this 300 billion financing, buy over unsold inventory, convert them into social housing. I think that's a good move, but I think that's only a drop in the ocean. I think they could afford to do more on that front. And lately, we talked about, I think we read about this mortgage refinancing, lower borrowing costs, trying to help to boost consumption. I think that's another good move, correct move, in a positive move in the right direction. So we hope to see more of that as well. But I think corporate confidence, that's something that they need to also rebuild, especially from the private sector. We have seen how they have actually come after the tech sector, in particular in terms of regulation. Obviously, if you look at the past 12 months, they have actually eased quite a fair bit. But from our interaction with a lot of the Chinese entrepreneurs, I think they are somewhat still skeptical, so we need time. We need time actually for the policymakers to convince these private sectors, entrepreneurs, to say, hey, you are important for the economy. Go out there, expand, create jobs.
We'll see what the rest of the year holds. Eddie Lowe of Maybank Group Wealth Management and Bloomberg M Live Executive Editor Mark Cudmore. Thank you both. Paul?
All right, let's just get you back to the remarks from the Reserve Bank of Australia Governor Michelle Bullock. She is giving a speech in Sydney at the moment. We did get the notes from Michelle Bullock in advance of this. So she is saying that monetary policy in Australia will need to remain sufficiently restrictive until CPI moves sustainably towards its 2 to 3% target. It is off a peak, but at 3.9%, still worryingly high. She says underlying inflation's fallen very little over the past year in quarterly terms. times, so the RBA board still vigilant to upside risks. However, she says it's also crucial to remember that our full employment goal is not served by letting inflation stay above target indefinitely, so that hawkish rhetoric from the RBA being retained. Still to come, Chinese President Xi Jinping pledging $50 billion in extra support for Africa as he addresses the continent's leaders. A live report from Beijing up next. This is Bloomberg. Chinese President Xi Jinping has promised $50 billion in support for Africa over 3 years as he addressed the continent's leaders in a speech in Beijing. Our Chief North Asia correspondent Stephen Engel joins us now from the event. So, Stephen, talk us through his comments. What stood out?
Well, it shows his commitment, continued commitment to the African continent. In fact, if you didn't believe it, look at the China Daily this morning. Essentially, all 12 pages of the main section of the newspaper are all about, guess what? The Forum of Cooperation between China and Africa and all of the policies that Xi Jinping has just laid out in his, I guess you could call it the keynote address, welcoming address to this FOCAC meeting, the 9th such gathering of African leaders, more than 50 leaders of African nations here in the Chinese capital, listening to Xi Jinping today, as you see some footage here. The entire city bedecked in, obviously, Chinese flags, but also African flags as well. Xi elevating ties in his speech with African nations to a strategic level. There's no doubt that Xi Jinping has seen cooperation with the global South and African nations in particular as very strategic, but now officially it is on strategic level. He's going to give essentially about 51 or 50.7 billion US dollars in financial support, either including or additional 30 billion US dollars line of credit to African nations over the next 3 years. Also, very interestingly, in a continent that some say the West has essentially neglected for decades, Xi Jinping is offering up about 141 million US dollars, a billion yuan in military assistance that would include helping train about 6,000 military personnel on the continent. We don't know which countries, and also another 1,000 police officers and law enforcement agents. Xi says China strives to create at least 1 million jobs in Africa and is encouraging Chinese companies to invest in particular the pharma industry in Africa and is ready to help Africa grow its green growth engine. That's a point of contention, obviously, as those in the West who have slapped tariffs on Chinese EVs upwards of 100%. They see China needing an export market for its excess and overcapacity of industrial products like EVs and batteries. And I guess Xi Jinping sees a market, obviously a continued market in Africa. Now, going the other way, not to Africa, but from Africa to China, Xi says China will give 33 African nations, again, not named, but he essentially said countries deemed as developed economies, going to give them zero tariff benefits. So their exports and their imports into China will not be tariffed. They'll be basically zero, and says China is willing to expand market opening to African countries. Again, as most of these speeches are, short on specifics and broad brushstrokes, but again, it was a positive message from Xi Jinping to those in the audience at the Great Hall of the People.
Certainly underscoring his priorities there. Stephen, you also had some really interesting conversations with the leaders present. What are you hearing?
Well, I did talk to the foreign minister of Djibouti, which is strategically located, obviously, in the Horn of Africa. There's a lot of conflict going on there, offshore and onshore, between rival countries there. Geopolitically, they're playing a very active role, offering Ethiopia it's landlocked, a pathway to the Gulf of Aden. That's a very contentious issue because other nations, including non-nations, semi-autonomous Somaliland, has also offered that kind of solution. But on the China front, he says there's no illusion that the balance of trade is fair necessarily between China and the African continent right now. But he says they need that cooperation.
We know that today, China has maybe not the same capacity, despite the fact that the willingness is there. We are living in a polarized world. There is something coming in the international arena. The African Union is trying to position itself. Now, we will certainly adapt to the new conditions that we are faced with. African countries have each one specific needs, specific expectations, but the priority should be to focus on strategic partnerships. When it comes to peace and security, we have an African architecture for peace and stability. We expect from China that China will support that architecture, specifically the Peace Fund. We also expect that China will step up in its support financially for the modernization of the plan that Africans set for themselves in terms of agriculture and so on and so forth. I think this is a two-way partnership. Of course, we know that China expects also a lot from the African continent.
They want better returns. Obviously, they've gotten minerals and they've gotten energy through their partnerships, through their 120 billion plus that they've invested through state policy loans. Yes. But they also want returns. So are you finding perhaps for African nations, the wallet is a little slimmer and it's not opening as wide as years past?
I'm not saying that the partnership is a balanced one. But we have to also recognize the fact that China is now one of the biggest industrial products producing country. It needs market. It needs, partners on the African continent. It needs minerals and natural resources. China has a boiling economy. At the same time, we also feel that we can take our own advantage of that partnership when we speak as a united African countries.
You may be hearing more from Mr. Yusuf as he is a candidate to be the next head of the African Union. Back to you guys.
All right, thanks very much, Steve. Chief North Asia correspondent Stephen Ingle there in Beijing. We have plenty more to come. This is Bloomberg. Let's take a look at how Asia chip makers are doing this Thursday. A bit of a mixed bag, really. We've got TSMC doing pretty well, better by 2.7% at the moment. SK Hynix also enjoying a rebound there of 3%. This is after the sell-off that we saw on Wednesday, really inspired by that vicious price action in NVIDIA. NVIDIA was actually down again today, another 1.7% in the US trade, but denies that it has received a subpoena from the Department of Justice. But we're continuing to watch that story. Samsung Electronics, though, weaker by 0.1%. We're also seeing Tokyo Electron a bit softer in Japan, not on your board there, but China has warned Japan of retaliation over potential new chip curbs. Let's take a look at China property stocks as well, banks and consumer stocks as well, because Bloomberg is reporting that China is considering cutting interest rates on up to $5.3 trillion worth of mortgages. At lower costs for homeowners, but squeeze profits for banks. We have plenty more in a moment. This is Bloomberg. Welcome back. We've got China markets just heading to lunch right now. It's a bit of a sluggish day on the mainland. We're seeing the CSI 300 just better by a couple of points. The Shanghai Composite, well, pretty much let's call it flat. And also some more news coming through that, well, a lot of big investment houses not that keen on Chinese stocks. We've got the offshore yuan there at 710.14 at the moment. And you see on the bottom of your screen, JP Morgan scrapping its bullish China stocks call. Let's get a little bit more on that. The outlook for stocks in China looking increasingly challenged. JP Morgan analysts dropping their buy recommendation. And a weak earnings season is putting hopes of a quick turnaround in doubt as well. Asia equities reporter Charlotte Yang joins us now. So, Charlotte, what does the JP Morgan downgrade signal about the health of the Chinese market?
Yeah, so this downgrade from JP Morgan to neutral from overweight has caught some attention in the market this morning. And what they're really pointing out is that you have the geopolitical risk becoming very relevant through the rest of the year with upcoming U.S. elections. And they're really concerned about the potential of another trade war in a scenario which the tariffs on Chinese exports being raised to 60% to 20%. And if that's the case, they see that the long-term structural growth of Chinese economy could be going downtrend. And resulting in a more accelerated global supply chain relocation from China. So with that said, they also think it's very difficult, to modeling this kind of risk premium for Chinese equities, and also highlighted some of the institutional factor that's difficult, to manage your China weight when China has such a high weight in the MSCI China index, and versus the growth of the emerging markets excluding China, and all of that combining with the economic factors in China with the housing market still persistently showing weakness, and all of that lead to the strategists' decision to reduce their weighting on Chinese equities.
And of course, Charlotte, it's been a really disappointing earnings season in China. What are some of your key takeaways, and where do we go from here?
Yeah, so the strongest signal we're seeing from these earnings season that's wrapping up is that the consumption recovery is becoming more entrenched than we have expected before, and that is due to certainly the weakness in the housing market, as well as weak confidence with the private sector. And give you some stats here. The earnings per share for the MSCI China index has fell 4.5% from the year earlier, and that's the worst in 5 quarters. And some of that is because before we had the strong support from the country's largest 8 biggest tech firms, but their EPS growth for the June quarter is also the slowest since the last quarter of 2022, and that is because a lot of these big tech firms, their earnings, a lot of the growth coming from the consumer tech, and with consumption being so weak and the confidence still lagging, it's not looking too good going forward to the rest of the year, this year as well. And Morgan Stanley's caution and investors that we could see further downgrade consensus estimates, and that the market could stay range-bound for a while.
Charlotte, reportedly Chinese authorities are also looking at this 2-step mortgage rate cut, and some say that this could essentially be wealth transfer to households, maybe spur consumption. What is your sense of, is this going to help consumer stocks? So far, I think judging from today's market reactions, we did see the property stocks gain a little bit while banking stocks fell. I think it's a bit too early to talking about its impact on consumer stocks. This kind of policies, I think investors like to see it, but so far what everybody's focusing on is really, the monthly sales and prices data for the housing sector. And until we see a decline slowing from that, or even some, or like more positively, some recovery, I think investors are very much taming the expectations for what that could mean for the broader consumer sector. All right, Charlotte, great to chat with you. Thanks so much. Asia Equities reporter Charlotte Yang. Now look at how markets in Japan are trading. We're seeing the benchmarks coming back from the lunch break looking pretty flat on the topics, and we're actually seeing declines on the Nikkei as well, and not quite partaking in the rebound that we're seeing across the region. Chip stocks in Japan are still extending declines from a day ago. There's that added complication for Japanese equities given how the yen rallied just a day ago following the US job openings data, and how that prompted these bets of aggressive Fed easing as well as a softer dollar. Let's flip the board because something else that's in focus today is the stock of Nippon Steel. President Biden said to be preparing to block its $14 billion takeover of US Steel, and sources say a decision could come as soon as this week. Let's get more analysis on the deal with Bloomberg commodities reporter Martin Ritchie. Martin, what is your sense of whether this is going to be a sort of foregone conclusion given how it's an election year?
Yeah, it does look like this deal, which is would have been a major step for the global steel industry. Japan, one of Japan's biggest steelmakers, taking over an iconic American steel firm. It looks like this is heading for trouble, as you said. People familiar with the matter saying that Biden is going to block that when the papers from his national security advisors, from the investment in America committee, when the papers reach his desk, he's going to say no thanks. Now, it might seem unusual to have a Japanese steelmaker blocked from taking over a major US company, Japan obviously being a major ally of the US. But as you said, this is an election year. Lots of US Steel's big plants are in Pennsylvania, a swing state. And so it's become a very sensitive political issue. Both US Steel and Nippon Steel has sort of indicated that this could go to what would be fairly complicated legal action if Biden does go ahead and block the deal. So we'll need to see how this develops in the coming week.
Martin, one does wonder who was advising Nippon Steel to do this in an election year. Surely you wait until 2025. That would seem fairly obvious. But connected to that, what's Nippon Steel saying to give some assurance to the US?
Well, throughout this deal, there's obviously been a lot of pushback from steel unions in the US, from politicians, both national and local. We had Biden before saying this company must remain American. We had Trump saying he would block the deal, and this week we had Kamala Harris saying that she would want the company to remain American. Throughout all of this, Nippon Steel has sort of added sweeteners. They've said, they would invest more in US steel plants to make it more competitive. They added to that investment figure last week. They've said the board of US Steel would be led by American citizens. They've done all sorts of things. They said no job losses. So they've made a lot of commitments to try and get this deal over the line. But it doesn't look like it's enough to overcome that sort of political opposition. And at the same time, US Steel itself is, the management is obviously in favor of this deal. They've said, look, if this doesn't go ahead, it's going to cost jobs in their plants. They do not have the money to spend on investment that Nippon Steel can give them.
All right, Bloomberg commodities reporter Martin Ritchie there. Just want to get you an alert on the Bloomberg out of Thailand. These are August CPI numbers coming in a little bit softer than expected, 0.35%. The expectation was for 0.4 of a percentage point gain, but that is a slowdown from what we saw in the month prior. What else do we have here? Well, of course, the context of this is we've got the Bank of Thailand keeping its policy rate at a decade high, 2.5%, and that's despite these continuing weak inflation numbers being below the target range for 3 months now. However, they are saying that September inflation in Thailand could accelerate on oil prices and the flood impact as well. So a bit of ongoing weakness there in Thai consumer prices. All right, let's get some more corporate stories that we're following. Alimentation Couche-Tard says the weaker US economy may improve its prospects for making a large acquisition. The statement was released alongside the Canadian convenience store operator's first quarter earnings, but it made no reference to its interest in Seven & I Holdings. An agreement for Seven & I would be the biggest ever foreign takeover of a Japanese company. HPE shares fell in extended trading after the company reported weaker than expected margins. Its gross adjusted margins stood at nearly 32% in the fiscal third quarter, marking a decline from a year ago. This suggests lower than anticipated profitability in its closely watched AI server businesses. Nvidia shares fell for a third session in New York, now down about 14% since last week's earnings outlook disappointed investors. Meanwhile, the company says it is in contact with the US Justice Department, but it has not been subpoenaed. This is in response to information from Bloomberg sources saying the DOJ had served subpoenas as part of an antitrust investigation. AI chip demand will boost growth for the broader semiconductor industry over the coming years. This is the view of major equipment supplier to TSMC in Taiwan, whose shares have outperformed the local benchmark this year. Scientech CEO Ming-Chi Su explained why in an exclusive interview with Bloomberg.
We are lucky in this AI industry. We benefit from the equipment that we build, the process that we develop with customers together to enable AI process. So that's why our investors value Scientech as a potential company who can really contribute in this industry.
And what sort of demand are you seeing? What's your outlook for demand for your equipment toward the end of this year, but next year as well?
The growth will be substantial for next few years. The increase, the growth rate, which will be much, much higher than 8%.
Can you give the number?
The equipment that we sold to them probably increase 2 or 3 times a year. It is possible. And so it is also benefit Scientech from their revenue.
Do you see any risk to that outlook?
From my personal perspective, this booming of AI industry just begin. There's a lot of application I do expect will coming out pretty soon. So that's why Jensen Huang, some time ago, he said the overall market of AI will reach 100 trillion at some point in the next probably few years.
We're seeing a lot of Taiwanese companies that are choosing to expand abroad. Do you see any sort of concentration risk from choosing to focus your attentions here?
Of course, definitely we will try to evaluate alternative locations, either for the R&D, for the manufacturing. Internally, this is under our processing.
Speaking more broadly now, what has been really capturing a lot of attention in the chip equipment manufacturer space or chip equipment provider space is the measures that we're seeing applied on Tokyo Electron and ASML and restricting sales of certain equipment to mainland China. That risk of tariffs or being prevented from selling to the Chinese market, is that something that concerns you or Scientech as a business?
My direct answer to you is no, because the equipment that we build are mainly for packaging applications, and the packaging applications is not included in this limitation.
Do you see that risk ever appearing in the future? Is it something that you're looking at closely?
We all know the advanced packaging is becoming more critical every day. Most likely it will happen, but who knows?
That's Scientech CEO Ming-Chi Hsu speaking exclusively with Bloomberg tech reporter Annabelle Drewlers in Taipei. Coming up, hear why analysts are staying bullish on Indian stocks as they post their strongest bull run since the early 2000s. Details next. This is Bloomberg.
Season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs.
Taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Markets have just opened in India. Let's take a look at how we're doing in the first few seconds of trade. And we've got the Nifty resuming its upward climb, better by 1/5% in the early going. Of course, it did break its 14-day winning streak on Wednesday, but one suspects it may be just a matter of time before it sets a new one. We've got the Sensex rising as well. The Nifty Bank Index better by 1/4%. The rupee, not a lot of change there, still hovering around record lows. Well, Bloomberg Intelligence says the torrent of retail funds flowing into India's stocks looks set to persist, sustaining what has become the market's strongest bull run in years. Asia equities reporter Ashutosh Joshi joins us now in Mumbai. So Ashutosh, India's obviously been one of the bright spots for equity, be it primary market or secondary. India just seems to keep on performing. How about the expectations for further gains already year to date, notwithstanding yesterday's pullback? Nifty's up 16%.
Yes, definitely. Hi, Paul. Strategists are sort of unanimous on outlook for Indian equities. They are seeing at least 3 to 6% further upside for the benchmark index for this year. India has been among very few markets which have risen for a straight 9 years. And this month we saw the benchmark index surging for 14 straight sessions, barring yesterday's. Obviously, there is bullish expectations on this. It is backed by the India's macroeconomy, which remains strong. There is expectation of growth continuing. Major event, which was national elections, is over, and despite a weak earnings season in June quarter, strategists haven't really changed their expectations for yearly growth. Backed by strong corporate earnings, there is a case for Indian equities to extend their rally.
Ashutosh, domestic inflows have also been a key force for Indian markets. Are there signs that these flows will dry up?
I don't think so. India has been receiving a strong amount of domestic liquidity. Indians have been largely investing in local shares through mutual funds. A significant chunk of this money is coming via the monthly dedicated investment plans. This has seen equities share of India's household savings more than doubling in last 3 years. At the same time, markets in India have outperformed. The yearly returns generated by mutual funds are far ahead or far better than traditional avenue for this money, which is bank deposits, or some of it was going into gold. So mutual funds or exposure to equities remains a key area of interest for investors. And as far as market performance continues, there is little sign that these flows will dry up.
All right, that's our Asia Equities reporter Ashutosh Joshi in Mumbai. Just want to get you across an alert out of Hong Kong. We are hearing that Hong Kong will issue a Typhoon Signal 8. That's going to happen at 6:20 Hong Kong this evening. So Hong Kong bracing for Super Typhoon Yagi, also heading towards China. So the T8 signal in Hong Kong, going to be hoisted at 6:20 Hong Kong time this evening. Plenty more to come. This is Bloomberg. The rising popularity of South Korea's entertainment exports has given its homegrown food brands a massive new platform to reach global customers. One of the industry giants, CJ Chaledang, is aiming to double its business within the next decade. CEO Min Sok Pak spoke to us exclusively in Seoul about their global strategy.
We've looked at the globe, and we've prioritized all the different countries and markets, and we have a list of the markets where we want to enter. And for us, Europe is an emerging market, as an example. Everyone else thinks about Southeast Asia or Latin America, but for me, Europe. Europe is a huge market opportunity for us, and it's one where we've been in Europe for a few years now, and we're growing 50% plus a year. And so there's a huge opportunity for us there. Korea has to stay as an anchor, really driving the innovation and our capabilities, but future growth really will come from outside of Korea.
Where does China fall into that mix of regions?
In Asia, China is an important market for us. It's a huge consumer market, particularly in food, and we have a very vibrant business there. We have local manufacturing, we have business in sauce, we have business in dumplings. We have some really exciting innovations that we actually launched in China last year with our new pasta lines there. So China is an important market for us, and I see definitely future growth opportunity in China.
When we talk about China, we tend to focus on the slowing economy, domestic demand being weak. Does that affect your business?
It does to a certain extent, right? You know, anytime when you have slowing domestic consumption, obviously as a packaged food player, it does impact you. But we happen to be in categories where household penetration is still relatively low, and there's a lot of excitement for the products and for the categories, and so we'll continue to grow that way.
When it comes to consumers, it's all about inflation as well and food costs rising. How is that affecting your business model?
I think it's impacted us just like it has all other food players. The commodity inflation in everything from grains to meats, the supply chain disruptions that happened in the last 24 months, it impacted us like it did everybody else. And so in many of our markets, we did have to take price increases to offset the commodity inflation and the supply chain disruptions. But I think what speaks volumes about the strength of our portfolio and the quality of our products and the value proposition that we offer is that despite the price increases that we've had to take to pass on some of the cost increases, we continue to gain market share, we continue to grow volume. And frankly, if you look at the last 12 months, when the rest of the industry, has been facing with volume declines as consumers return back to pre-pandemic consumption levels, we're one of the few players, if not the only one at this scale, that continues to grow volume, that continues to gain volume share as well as revenue share.
You were on a buying spree just a few years ago. Do you have any more acquisitions in mind?
We'll continue to look at M&A opportunities in all of our markets, both in terms of potential bolt-on acquisitions that would would augment and complement our portfolio, as well as platform-type acquisitions that will help us accelerate the entry into those markets. So our teams are, constantly looking at the inorganic options, and we look at how it fits with our overall strategy.
CJ Foods CEO Min Sok Pak there, speaking exclusively with the Asia Trade co-anchor Sherry-Ann in Seoul. Stay tuned for more on South Korea's cultural investments and plans to attract 20 million foreign tourists this year. Our exclusive interview with Culture and Tourism Minister Yoo In-chon coming up tomorrow on the Asia Trade. OK, we're expecting a rates decision later today coming out of Malaysia. No change, though, expected. All 21 economists surveyed by Bloomberg anticipate the Central Bank of Malaysia keeping its policy rate on hold at 3%. There are signs that growth and inflation are looking good. In Malaysia, the ringgit is also leading gains in the region. We'll leave you with pictures out of Hong Kong as the city prepares to raise that typhoon warning, Signal 8, later on Thursday. This is as Typhoon Yagi approaches the city. Winds of more than 200 kilometres per hour. This is the equivalent of a Category 4 hurricane. Bloomberg Markets Asia is over. Horizons Middle East and Africa.